Hi, this is Randy Finney with Right Side of the Chart, and today's Wednesday, March 22nd, 2017. In this video, I wanted to take a look at the QQQ and the top components for those of you who followed the site for a while. You know, from time to time, I like to look at the top 10 components of the Qs. I do that for a few reasons. Number one, and I'll make the case here in a second, the QQQ is what I refer to. I don't know, I've never heard this term in the financial media or anywhere else, but I refer to the Qs as a leading index. Why do I refer to it as a leading index? Well, let's just start there before we get into the charts. I'm going to go to a weekly chart here. Let me find a clean board, get rid of all the annotations. Okay, the QQQ, first of all, and again, remember the QQQ is the tracking ETF for the Nasdaq 100. The QQQ, unlike every other major U.S. stock index, which bottomed in March of 2009, they bottomed back in November 2008. That's when that index bottomed. Well as of course, the Nasdaq 100, which it tracks. And you can see from that point, if you look at the pop-up box in the upper left-hand part of the screen, look down towards the bottom with the green, you can see that the Qs gained about 425%. Now let's compare that to the other major indices. We'll start with the Dow. I don't do a lot of analysis on the Dow. The Dow, to me, is a very undiversified index. It's only 30 companies. 30 companies are not indicative of the U.S. economy. But with that being said, they try to spread it out, and it roughly tracks the S&P, give or take. And most of the major indices move together in unison, not necessarily in percentage. So we were at 425% gain in the Nasdaq 100 or QQQ. Here's the March 2009 bottom, where you'll see every other major index bottomed. And the gain was only 226%. So just over half of what the QQQ did at 425%. Okay, that's a big disparity. Now here's the S&P 500. This is one of the most indicative sectors really of our economy. These are all mega cap, large cap companies, but you can see that the S&P a little bit better there at about almost 260%, but not anywhere close to the 425% of the Qs. We'll even look at the risk-on stocks, the small caps. Small caps have much higher growth potential, small cap companies, because they are small. And you get those large cap companies like in the S&P 500 and the Dow. They're mature companies. Sure, they're making money, and over time they grow, but their growth rate is not as fast as small companies, which will eventually one day a lot of these small caps become mid caps, and then they become large caps, and then mega caps down the road. You know, everybody started out here at one point. Every company was a small cap at one point. Most of them, I should say. A few exceptions. You take companies like Facebook went public and they were already mega cap, but that's all right. I'm digressing. 311%. So there you have still a vast underperformance. So my point's been made that the Qs not only bottomed before everything else, but have also by far, not even a close second, outperformed every other index. And as such, they are the leading index. And when the Qs break, the market breaks. The Qs are also a very, believe it or not, a very undiversified index. Or I shouldn't say very undiversified. First of all, I talk about this often. The Qs are top heavy, meaning that the top 10 components of QQQ represent or account for over 50% of the returns. So half of the returns come out of just the top 10 holdings. This is, I have the holdings here in this watch list listed by market cap, and you'll see roughly these are the top 10 holdings. I think Gilead down here is right now showing at 12 or 13. You have a couple share classes of Google, but again, these are for the most part your top 10 holdings. So I'll just go over these, and I like to do that because I can either confirm my analysis on the QQQ or refute it. If the charts of the top 10 holdings and the Qs don't really align with what I'm seeing, whether it's bullish or bearish on the Qs, then that might give me pause. This chart here on the Qs I've covered ad nauseum over the last few years, really. And it just shows my trading style, simple yet effective. You can wait patiently. At least on the short side, you look for these divergent highs. Each one's marked, followed by corrections. And, for those that say, oh, well, this is a bull market, you can't short a bull market. The drops here range from 25%. I'd have to grab right on there. I move all the trend lines, so I'm going to go a little high and then stop a little short. 18% or so. There have been some very profitable corrections. And the thing, remember, guys, stocks typically fall much faster than they rise, and it is more of the norm to see, weeks and even months of gains wiped out in mere days. So that's one reason that you have to get your timing right on shorting, and you certainly in a primary uptrend like this, you don't want to stay late to the party. In other words, you need to cover. And my track record, I do a really good job. I haven't missed a single dip in the market in years. But I can often be early. You have, for example, you look at this bearish rising wedge right here. You see a breakdown. That was probably a short signal back then. I can't recall what I was doing on that particular day, but then the market pushed higher. That sometimes you get the back test, sometimes you don't. You had a back test here. We broke this minor uptrend line right here that I've been watching and highlighting on the 60-minute, yet the Qs stubbornly pushed up and were the last index to roll over. Again, they've been the leading index even recently. I pointed out on the site several times recently that every other index, without fail, besides the QQQ, peaked on March 1st. We're already on March 22nd. That's 3 weeks into the month. And all those other indices are off their highs that they put in back on March 1st, so in a confirmed near-term downtrend. Whereas the Qs stubbornly pushed up until just recently and didn't peak until the 16th. So it's only been a few trading sessions, but it finally gave way, finally buckled or succumbed to the technicals, is the way I like to look at it. All right, enough on that. That's the bigger picture. Price targets, all that other stuff, the 60-minute charts I'll get into later. The main point of this video was just to take a look at the top 10 components and see what they're telling us right now. Here's Apple. This daily chart really doesn't have a lot. Forget about everything to the left other than the fact you have a series of uptrend lines and downtrend lines, and those are your buy and sell signals, and they're fairly effective. Excuse me. What I'm watching now, you have a pretty well-defined trend line here that hasn't been visited in a while. In other words, the last time we touched that trend line was here. We had a gap up and a big ramp up. Minor little uptrend line. I'm not crazy about this. We can play around with it, maybe put it like that if we want. There's not a lot of reactions, but either way, at the bare minimum, my expectation is to revisit this trend line again. And just to revisit that trend line, even if it holds the support, that might be a buy point for you if you're bullish Apple. You're going to drop, Apple has about 3.3% downside if it takes a few days to get there. So that's that. And I don't see anything screamingly bearish in the chart, except it was extremely overbought recently. A little bit more on the weekly chart. This one tells me a different story. This is my long-term weekly chart of Apple. I have several trend indicators. The 40-week moving average, when it's trading above that, you're in a bull market. So we're clearly in a bull market or a bullish trend, primary uptrend in Apple. Couple things to note, however. Let's go down here, start with the RSI. You can see the RSI down below. I'll zoom in a little bit. These areas here, I left out a few arrows. Imagine that's purple. Just color these arrows purple, if you will, and add another circle here. What I did, see this purple line? It says extremely overbought. That line is at the 77 level on the RSI. Traditionally or typically, any move 70 or above is considered overbought on the RSI. And again, we're looking at a weekly time frame. So I treat every stock different. I don't just go by. If you look at that, you have a ton of overbought readings that really didn't pan out for anything in Apple. So Apple's magic number in my book on the RSI, I put that purple line there. It tends to really stand out. And you could even move it up a hair, probably to the 80 level, and still have it effective. But I have it at 77. And again, these arrows, if I had time to color these purple, I would. You can see we had one here, one here. They're all circled, and then the arrows are above. So what does that tell us? Okay, you might say, well, this wasn't much, Randy. Let's see what this correction back here. However, that was good for. I have to move that line to grab the top, go down to the bottom. I use log scaling. So although that little blip doesn't look like much, that was a 26.5% drop from highs to low after that reading. From here, well, let's even look at the small one. This was the first reading because that's really where we're at now. A lot of these were consecutive readings. They having two tags above that level, usually the second RSI peak being a little lower, giving you a divergent high. But there's a 15, almost 16% drop. I already measured this one out, 45% drop. So these are rare. Again, this spans a decade, and we only see a handful of these readings that exceeded that 77 level on the RSI. This is one of them. So although in most cases it was the second reading, and again, I thought I had this chart marked up properly, guys. Oh yeah, that one never had a second reading. So this arrow should actually be back here. My mistake. Excuse me. Okay, that purple arrow needs to go away right there, because but it was a divergent high, and that's what marked the correction there. So one possibility is that Apple goes on to have a correction here, because it's always pulled back on these 70 levels. They'd never stayed very long above the 77 level on the RSI. So maybe we pull back, come back in, and make that new high that a lot are calling for. And that would certainly mesh well with the charts, and in doing so we could have some nice negative divergence down here with the RSI going on to put in a lower peak, let's say down here a few months, and prices moving higher. That would give us our negative divergence. Maybe we ride up along this, see this yellow trend line, we broke down, back tested again. So maybe we continue to crawl up that level. Maybe, maybe not. Let me warn you, I've seen many charts where you have, it seems like a series of these consecutive cluster of divergent or overbought readings and negative divergence, and then every now and then you get a random one-time tag of overbought, and that's it. So we do not have to go higher. I want to make that very clear. And right now, in fact, if we look at the other indicator I'm using here on this weekly chart, we have flatline divergence. See this equal peaks on the RSI, I'm sorry, the PPO down here, while prices are making a higher high versus these previous highs. That is, I don't have the line drawn out, I'd have to put a line here, that is negative divergence. And when you get negative divergence on the weekly time frame, we have only had a few in the past. Let me show you what's happened. Now we're just again focusing on the PPO. Again, those are equal peaks there against prices making a higher high. So what we had is that 26% or so correction, the 45% drop, and this is the largest divergence that we have. Just as we had bullish divergence down here at the lows, I pointed that out as well, bullish falling wedge. So that was a small divergent low, and it did play out for a rally. So just be careful. There's some mixed bag technicals there. We don't have anything remotely close to a sell signal on Apple, but I can make the case for at the very least a pullback. And again, I've spent a lot of time only because Apple is the world's largest company, one of the leaders. Oh, one other thing I wanted to point out on Apple, and then I'll move on. Probably spent way more time than I should, but I think this is important. I used to be the mindset, years ago that where Apple went, the market was going to follow, because it was, it's teeter-tottered between the world's largest company, the world's second, third largest, depends on where it's at compared to some of the other big names. ExxonMobil used to have the lead, and then at a time I think Alphabet took it. But here's the thing. We had back at this point, and as well as this point, we had a 45% drop back in 2012. And you'll just have to take my word. It gets too long if I start flipping back and forth the charts. So we had a vicious bear market. Apple was chopped nearly in half. Again, I use a log scale, so don't let that fool you. That might not look like much, but the stock price dropped 45% at that point. That's a huge correction. And we also had a bear market in Apple. This drop at this point was 32%, and I said at that time I expected more, and sure enough, we had more downside. Apple didn't stop. That correction was, let me clean board it real quick. From the highs, ballpark, that was a drop of 32%. So there's two bear markets, if you will, in Apple during the bull market in equities. So Apple, although it is such a heavy-weighted component of the Nasdaq 100, can do its own thing. In other words, it can push onto a new high with the market rolling over, selling off, or it can have its own bear market while the rest of the market, including the Nasdaq 100, which it's the largest component of, could have its own, go the other way. All right, we'll fly through the rest of these charts. This is long-term chart weekly, Alphabet. There's still work to be done on all the weeklies. I'm just going to run through these fast. Microsoft, these are the primary uptrend lines. So let me just say this. The bull market is nowhere near in jeopardy right now. There's some long-term trend lines as I'm going through these top components, Comcast. These are all the bull market trend lines. So I think you guys could catch those. I know I rifled through those charts pretty fast. Intel, there's the purple trend line. So they're just about all the top components are still above those trend lines. But from the looks of it, these bull market, as you guys know, this is the second longest bull market in history. We're very far into this being the second longest bull market in history. So it's very long in the tooth. Sooner or later, those trend lines break. Sooner or later, we get a bear market. I still maintain that will be sooner than later. But you guys can do what you want, but be careful when all these big components start breaking those bull market uptrend lines. All right, we're going to go through the daily charts a lot quicker so I can wrap this up and just make my point. Okay, here's Alphabet, Class A, GOOGL. I'll stick with the daily time frame since we already viewed the weeklies. What do I see? What stands out to me? A very well-defined uptrend line, numerous reactions, and yesterday we smashed through it impulsively, that candlestick. We're having a little relief rally today, which is to be expected. I wouldn't be shocked if we went down and immediately followed through on the downside today. I'm not going to say I called for a bounce, but it should not be a surprise when you had such a large down day. You're going to have dip buyers come in. You're going to have nervous shorts that have been beat up for months, taking quick profits, things like that. But from a charting perspective, this is a beautiful short entry. I'm playing the Qs because all of these charts look almost identical. So I think it's a one-time where you can short the Qs as an index because all these big components fall. The Qs are going to fall in line. There's not going to be a lot holding it up. So futures, put options, ETFs, things like that. But you can see at best, Alphabet looks like it may want to make a back test and then roll over and head down to any or all of these lines, at least this level down here. And that's another 2.5% drop. Okay, there's the other share class, GOOG, same story, back to breakdown, back testing, technical levels, let's move on. Microsoft, pretty well-defined uptrend line, as you can see, very long-standing. If you look at this line here, from this peak to this peak, the story is the same on all of these guys. Powerful negative divergence that much, much, much more often than not play out for trend reversals. It can take time, and I pointed out divergences along the way. And the smaller divergences have played out for corrections. Some were sideways in time. As I always say, prices can correct two ways. They can correct or stock can correct in two ways. In price, meaning a move down, or in time, meaning a move sideways. So we had a divergent high right here. It was small. I had to draw a line from that peak to this peak. And we had a sideways correction. It did go down a little bit in price, but mostly sideways and then pushed up. But now we have much more powerful corrections. We have a breakdown. Microsoft has not given up the ghost yet, but I think that it will. And I think that magic number for Microsoft is right here at about 63.85, give or take. Tried to show you that value. There it is, 63.85. All right, so that's just one of many. Here's Amazon. Pretty well-defined trend line starts back here in February or so. Looks like late January, early February of 2016. A couple reactions. Nothing major. Again, I look at a trend line, and the more tags that it has, the more validity I give to that trend line. But this one, there's a few. Amazon's dancing on it now. Negative divergence. I wouldn't personally short Amazon. It's just a juggernaut. If the market sells off, what happens is even good companies get sold down. It's sympathy selling. People start pulling their money out of QQQ in their Nasdaq 100 tracking funds or their technology funds. These guys all get dragged down with it. It's called forced selling. At Facebook, pretty well-defined uptrend line, cracked yesterday, closed below, and we're following through to the downside today. So Facebook, most certainly, in my opinion, I didn't draw out this even smaller divergence here at the most recent high. You can see that. This would show better on the 60-minute chart. See this little channel type wedge breakdown, very long standing powerful divergence. So again, I can easily see the possibility that this isn't just a quick 2, 3, 4% overbought pullback in the market. But the potential is in the charts for a whole lot more. So just stay flexible. Don't get married to any one view, whether it's bullish or bearish. Let the charts do the talking. Comcast, pretty clear, pattern of divergent high correction, divergent high correction, divergent high wedge breakdown and back test right here. See this bearish rising wedge? Breakdown back test. It's moved sideways, corrected so far in time, really. But there's a big level right here, and that's about 36.90. When that cracks, I think it'd be a swift move down here, at least 35.64. And ultimately, not personally short this one, as I said. I'm short the Qs. 34.10 would be my minimum target, my minimum swing target if you're willing to ride out any of the counter trend bounces. Cisco, pretty well defined uptrend line, negative divergence, extreme overbought. I mean, talk about a stock that got overbought. We tagged up almost 90. It was 80, almost 88 on the RSI. It's sitting on this little support shelf right here, about 33.84. Already broke this trend line. So when that goes, it gives up the ghost, and I don't see anything stopping that stock until it hits at least this 32.88 level. Not a huge move, but just try to quantify it. That's about a 2.73% drop. So, excuse me, the common theme is looking for 2 to 3% minimum drop in the Qs, minimum downside from here. So you can play that. You can leverage that via the leverage ETFs, NQE minis, however you want. But that's and those are the next sell signals, by the way. We're holding those supports for now on some of those stocks. So when you see those crack, if you guys, because I get the questions, do I add now? I wasn't short going into today, or I had a little short exposure. I'm giving you the levels to watch. When those levels crack, that opens the door for the next wave down. Intel, I already covered this one in the semiconductors. Pretty well-defined uptrend line. Breakdown, back test. It hasn't really moved down impulsively yet, but it is in a precarious technical position. We had a divergent high. You can see there, negative divergence, breakdown, and back test of that uptrend line. So again, I'm just going across the board here. I'll stop in a second. I see a lot of breakdowns on these top 10 components. I'm just clicking by market cap here. Charter, that's been one of the big companies in the Nasdaq 100. Look at this. I don't know if there's something going on. When you get prices compressed like this, there might be an offer out, some type of merger acquisition. Usually that's what happens when prices compress like that. So don't put too much into that one. I'd have to look into that. I'm not sure about that. So there it is. I'll stop there because I really wanted to hit on the top 10. This is one of the largest holdings in the Nasdaq 100, and this is about the only chart that looks bullish to me. Probably a little more downside, but this is Gilead, bullish falling wedge. And the reason is this one's already had its own bear market. From the highs back here in 2015, Gilead has dropped 47%. So it's been chopped in half. It's in a bullish falling wedge pattern, confirmed with negative divergence. There it is on the weekly chart. Has real nice support down here at 64.75. So you want my best guess on Gilead, and there's negative divergence there as well. Positive divergence, just as we had a divergent high there. And I pointed that back out at the time in that biotech video when I was calling for a bear market at the biotechs right before they peaked back in 2015. But this one's come full circle. And so if you want my best guess, maybe a little more downside, 64.75 would probably be a good buy point for Gilead, especially if the market firms up and the biotechs firm up. Some of these biotechs can go against the sector, but it's best to align your trades with the sector they're in first and foremost, and then be the broad market. So, again, my best guess is maybe another thrust down in Gilead. And then, of course, your buy signal would come if I don't have an alert already. I will, is a break of the downtrend line. All right, guys, we'll wrap it up here. That's my take on the top components of the Nasdaq 100. Still think there's more downside to come in the market. And, if you're not comfortable shorting, at least hedge, tighten up your stops on your longs. And I'll also do my best to identify areas to step in and buy the dip for those of you guys that are looking for this market to race off to new highs soon. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.